Okay, just give me one moment while I share my screen. Okay, can everybody see my screen? I'm assuming you can. Okay, good. Okay, so today's presentation has to do with co-ops, co-op accounting. It's a very brief introduction. And just let me say at the very start, this is not the easiest thing to understand. I don't want to scare anybody away, but I'm just saying that, if you don't get every little piece of this the first time through, don't feel bad. It's probably helpful to go through this, maybe rewatch the video, go through the slides again 2 or 3 times. So don't feel bad about that at all. Okay, my name is Chris Bertels. I'm a CPA. Right now, I actually reside in Washington, D.C. But as John mentioned, I'm actually truly from a very small town called Centralia, Washington, which is probably about 20 miles south of Olympia. But now most of my family lives in Olympia, so I'm very familiar with Olympia. I'm going to be visiting next month for at least a week. There are three primary financial statements. They're the income statement, the balance sheet, and the cash flow statement. And in the next couple of slides, we're going to go into a little bit more detail as far as what the income statement entails, the balance sheet, and then the cash flow. And let me also say that if anybody has any questions, don't hesitate to, don't hesitate to ask questions. And if I'm going through it a little bit fast, for most of you, then just tell me to slow down, and I will slow down. So the first financial statement is called the balance sheet. And the characteristics of it is as of a specific date. That's really important to understand. So, it might be December 31st. It could be today, which is the 24th of February. But it's basically, what the co-op owns, and then what the co-op owes to others, and excluding to members, and then what the co-op owes to members. Okay, so on the right hand side, we just have three components. The balance sheet is composed of assets, liabilities, and member equity. Those are the three basic building blocks of a balance sheet. Every single balance sheet is going to have those characteristics, although often, you might see a little bit different terms, especially as far as the subcomponents of it. The next financial statement is the income statement. It's also often referred to as the profit and loss statement, but income statement would be the traditional term. The profit and loss statement, I think that gained greater, in the wider literature because of an accounting program called QuickBooks, which is, it's for small businesses. They call the income statement the profit and loss statement. So I think because of that, it's somewhat more common in the small business community to call it profit and loss rather than income statement. I have no idea why they chose profit and loss statement. I guess it just is what it is. And the important point here is that an income statement is for a period of time. The most common would be for a month or a year. Okay, so in contrast to the balance sheet, which is as of a specific day, the income statement is a period of time. And I would say that an income statement, when people think of words or terms like how much money we made, that's really referring more to the income statement. Whereas a balance sheet is referring to what the co-op owns. So the co-op is going to have, it's going to have a bank account with cash in it. That's going to show up on the balance sheet. It's going to have all different types of equipment. It might have loans. Those are all as of a specific date. The key components of the income statement are revenue, cost of goods sold, gross profit, expenses, and surplus. And we'll talk a little bit more later about what those specific terms mean. But revenue basically means um, the money that you collected from your customers. It's often called sales, or sometimes I think it's called income, which is a little bit misleading because accountants have a little bit different term, or a concept or a definition of income. Cost of goods sold is it's basically the cost of the products you're selling. So, if you're selling bread, then cost of goods sold is going to be the physical ingredients that go into the bread, like flour, sugar, yeast, those type of things. Gross profit is just revenue minus cost of goods sold. And that's designed to tell you how much you're making on each individual product, because it's how much you get from the customer less the physical cost of the goods that you use or the ingredients you used to produce the revenue. Expenses are that's basically the costs of running your business. Sometimes they're called operating expenses. There's various different terms for all these. Most of these terms I'm using, there's a lot of different alternative names out there. So if you see an income statement or another accountant refers to some of these terms, it doesn't mean they're wrong. And if they refer to them in different terms, it doesn't mean that they're wrong. They're just using an alternative name. So that actually creates a lot of confusion, I think, for new people that are not familiar with the terms. But I guess that's just the way it is. And then surplus, it's also called net income. Net income tends to be a specific term that's used for businesses, whereas surplus is pretty much always used for co-ops. Sometimes co-ops will use the term margin or net margin, but they're all basically referring to the same exact thing. And when people say, how much money do we make? That generally refers to the surplus. It's how much money is, or how much money did we make? It's basically the money you collected from the customers minus the costs or the expenses that you paid to your vendors. So that's going to be, how much you paid for rent, how much you paid for salaries and wages. The third financial statement is the cash flow. And that is just designed to show the cash that's coming into the co-op less the cash that's going out of the co-op. So over the long term, you need to have more cash coming in than cash going out. And this is also as of a period of time, just like the income statement. It's for a year, a month, a quarter. You could do it for a week. You could do it for actually a day, although that's really a lot of work, probably for not much benefit. But there's nothing to stop you from doing that. It has three key components or building blocks that you use to create the cash flow statement: cash flow from operations, cash flow from investment activities, and then cash flow from financing activities. So the end result of the cash flow statement is it has to show how much cash you have in the bank at the end of the year or the end of the period. And it has to match how much is on the balance sheet. So remember, the balance sheet tells you how much how much cash and other items you own as a specific date, whereas the cash flow statement shows how much cash is going in and out, and the end result the is the cash in the bank. So they would have to match. If they don't match, then that means there's something wrong. Just really quickly, there's a thing called a limited cooperative association, which I think is in 6 states and the District of Columbia. I would anticipate that most of you are not going to be limited cooperative associations, but if you were, then some of the following slides, they may not apply exactly. I mean, most of what follows is going to also apply to limited cooperative associations, but some of it will be different. I would anticipate that all of you or most of you are going to be what's known under the, under like Washington state law is a corporation, and limited cooperative association is basically it's basically more like an LLC. Okay, the scenario for the following slides is it's a bakery co-op. It's started by 5 individual members. These members are employee owners. The patronage is going to be based on hours worked. And the term patronage is really very specific to co-ops, and that basically means I would describe it as how you define the amount of business you're conducting as a member with the co-op. It's going to define how much it's going to define the allocation of, or determine the allocation of the year-end surplus to the individual members. In the context of a workers' co-op, it's usually defined as hours worked. So that means that the more hours you work, the more surplus is going to be allocated to you at the end of the year. There's other ways you could do it, but hours I think would be the most common. And this co-op actually needs $100,000 as startup money to either buy the bakery or start it from scratch. And the way that they're going to fund the $100,000 is they're going to get $10,000 from the 5 members, and they're going to get a $9,000 or $90,000 bank loan. This 100,000 is often referred to as capital. People might say that the co-op needs $100,000 capital to basically fund the co-op or get it started. Okay, so the members are going to contribute $10,000 of the 100,000, and each member is going to put in or contribute $2,000 to the membership. And all these numbers I've just totally made up. I would expect most of you, if not all of you, to have a much lower number than $2,000 per member. But for this purpose, we're going to use $2,000 because it's a nice even number, and it just makes the calculations a lot easier. Okay, so I mean, don't get intimidated when you see all these numbers, because it's really not as complicated as you think. So if you remember what I said, the basic building blocks for the balance sheet is going to be the assets, and then the liabilities and the member equity, and then within those categories, it's broken down further. This is a really summarized balance sheet, so it doesn't show all the details. I mean, in real life, you're going to have a lot more lines on the balance sheet. Just really quickly, the term current assets, that's a type of asset, and that really refers to assets that will be used in the next year. So in cash, it's cash is pretty much always going to be a current asset because you would expect it to use cash in the next year. Okay, so the fixed assets, that is a subcategory of asset, and that refers to assets that are going to last more than 1 year. So fixed, so like an oven, for instance, an oven you would expect to last a long time. I don't know how long an oven lasts, but it's definitely more than 1 year. That's why it's a fixed asset. And just to reiterate, a balance sheet is showing you what the co-op owns as of a specific date. So as of today, in the 4 categories, and just starting, it has 0 cash in the bank. It has it doesn't have an oven yet. That's why it's 0. And then it doesn't have a bank loan. But it's the main point is it's showing how much or what the co-op owns as of a specific date. Now, as far as the handling the transaction of the 5 members putting in the $2,000, that's going to affect cash, okay? Because before there was 0 cash because you're just starting up, and then after the members contributed the $10,000, then you have $10,000 of cash. Going to the right side, the bank loan, there's no bank loan yet. No money's been borrowed, so that would just be 0. If we go down to member equity, and if you recall, that's basically, how much the co-op owes to the members, and we'll talk about these individual lines later. But the members contributed $10,000. So the co-op needs to keep track of that because they need to know how much they ultimately owe to the members. This member equity is ultimately telling you that the co-op owes $10,000 to the members, and that might be paid back next year. It might be paid back in 10 years, but eventually it's going to be paid back. Usually when the individual members are going to terminate their membership or they're going to leave the co-op, then the co-op will give them back the $10,000. So just in summary, we have $10,000 of cash, and then we need to keep track of the $10,000 that the co-op owes to those members. Oh, okay, so another thing that I should say is, if you notice, this transaction didn't impact the income statement at all. It only impacted the balance sheet, and that's a really key point. The balance sheet for our purposes today is, okay, so we have a question. Yep.
Yeah, I didn't want to interrupt you, but so what many people are doing here is converting from a existing business into a co-op. So my question has to do with, does the co-op essentially buy the business? So you put a value on the business that then becomes a liability, just like a bank loan, and then the members then have to pay that off.
Yeah, right.
Is that how it works?
Okay, so that's a very, very good question, because probably, I'm assuming that at least some of these co-ops are going to be doing exactly what you stated. Okay, so the quick answer is it's going to depend on every single situation, because each situation is going to be different. But usually what is going to happen is you're going to have the what I'll call the old business, which is the existing business, and then you're going to have the new co-op. So those are totally different. And then what usually would happen is the new co-op, it needs capital, it needs cash, and it needs funding in order to buy the assets, which is the equipment and other things that the old business owns. So I would expect that, it's going to work the same way that, the members are going to put in a certain amount of cash. So it might not be $10,000, it might be $1,000, or it could be more. And then usually the new co-op does not have enough cash in order to buy the assets from the old business. So they're going to have to borrow money. And it's either going to be from the bank, or it's going to be essentially from the old company, like the owner of the old company. And the next transaction we're going to go through is talking about the bank loan. So you're going to see how that would work. And it's going to be the same whether you borrow the money from a bank or you borrow the money from the business owner. The transaction is just going to be the same. I mean, instead of saying bank loan, you might say amount owed to previous business or something else. I mean, the exact terms don't matter. What matters is that it's a liability, because that's how much you owe to someone else.
So do the owners of the old business, when that money is paid to them, is that then the capital gains to them? So you have to separate out what you pay?
Okay, yeah, so that is going to, I mean, the question of like capital gains, that's gonna impact the old company.
Okay,
That's not gonna really have any impact on the new company.
okay, all
Yeah,
right.
yeah, it's not
Thank
gonna
you.
have any impact on the new company.
Okay, thank you.
And there's different ways that you can buy the business. I mean, mostly it's done as the new co-op buying the assets, the equipment, and the cash that the old company owns. So what I described previously is that's the most common situation, but you can also have situations where the new co-op is buying, the actual business. So they basically taking over the old business. So the old business and the new co-op are essentially the same. That would be that's not very common, but that can also happen, and it's going to be a little bit different, situation.
Okay, thank you.
Yep. Okay, so the co-op, as you remember, they need $90,000 bank loan, so they can get the 100,000, and they borrow it from a bank. I guess going back to your question too, and if you have a bank loan, I mean, typically the bank is actually going to give you the $100,000, and then you're going to use that money to buy it from the assets from the old company. So you're probably going to see $90,000 hitting the bank account. But if you're buying it from the business owner, then they usually, they don't usually transfer actual money to your bank account. It sort of happens on paper, but the general concept is still going to apply. That's just getting into a lot more details probably than we need to. Okay, so the balance sheet, 90,000 bank loan. And as you can see also, this transaction actually does not affect the income statement either. It doesn't have anything to do with the customers. It's just internal how we're funding the business. Before there was $10,000, they got $90,000 from the bank. So now they have $100,000 in the bank. And now you can see there's a bank loan for $90,000, because you have to, reflect on the balance sheet how much you owe outside parties. And then actually, if you look at this right-hand side, the co-op needed $100,000. So you can see that they got $90,000 from the bank, and then the $10,000 on the membership contributions. And the total adds up to those adds up to 100,000. So the next transaction we're going to consider is the bakery needs an oven to bake the bread, obviously. they're going to need a lot more equipment than that, but just to keep it simple, they're going to use $20,000 cash to buy the oven. Okay, so they had $100,000 in cash before. They used $20,000 to purchase the oven, so that means there's $80,000 left. And since the co-op owns the oven, it has to be shown on the balance sheet because it obviously it owes it, so it has to be reflected somewhere. And then the right hand side, as far as liabilities, the co-op does not have any liabilities because they didn't borrow any money. They don't owe any money. If you're buying the oven from the old company, then you're going to have a liability because you're going to owe money. And then the member equity, that didn't change. The next transaction is what I'm just summarizing is various cash sales and expenses. So the sales are going to be the sales of the bread, for instance, and then the expenses are going to be the cost of the ingredients that are going to be included in the bread, and then salaries and a whole list of things. Okay, so the income statement, and once again, I just totally made up these numbers. So the co-op sold $300,000 of bread. So that's how much they got from customers. And in this instance, it's cash that they got from the customers, no credit cards or that sort of thing. And then cost of goods sold is $200,000. So that's essentially a form of expense. Cost of goods sold, it's often just summarized as COGS, COGS, but that's sort of like a special expense. And that's in this context, that would be the ingredients that they use to bake the bread. So after subtracting out, there's a gross profit of $100,000. So that's essentially the gross. That's essentially what you would call the surplus just from the sale of the bread before the supporting expenses like salaries. Expenses is there's in real life you're going to have a lot more expenses in this, obviously. I mean, you can make pages and pages of expenses if you want to. You probably don't need that much detail, but you can. And expenses is oftentimes you often see a label operating expenses, but that's just a different name for the same thing. The co-op paid $25,000 to the employees for their salaries and their wages, and they paid $15,000 in rent, and then utilities of $5,000. That's cash actually going out from the co-op. The only cash coming in was this $300,000 from the customers. And then when you total the expenses and subtract it from the gross profit of $100,000, the amount that's left over is $55,000. So when people say how much money do you make, they're usually referring to this number right here, which in the co-op world is usually called surplus, or often is called margin. But it's, in a business world, it would be called net income. It would be called profit. They're all essentially measuring the same thing. I mean, there's different theories, that makes sense actually for why co-ops should call their profit or their net income surplus. But it's essentially measuring the same thing. Okay, so these are the cash expenses recorded on the income statement, and those all basically impact mostly the activities with the customers or the cash outflows that relate to the bread sales. Okay, so there was $80,000 of cash, and then if you remember, the surplus was 55,000. So now there's $135,000 in cash. Okay, bank loans, it didn't change because no more money was borrowed or paid back. And then, as you can see under the member equity, I've added the surplus of 55,000. So the way to think about that is that's potentially how much is going to be distributed to the members at some point. So in order for this to balance, just mathematically, it has to be put here under member equity. It essentially belongs to the members, and later it's going to be allocated to several different categories, which is really unique for co-ops, and we'll get to that later. So this surplus is always going to have to be in member equity. That's just in order to balance everything. And then one thing we did leave out was is a bank payment. Like the bank is going to want money to pay down the loan, and they're going to want interest, of course. Okay, so in this instance, the co-op paid 55,000 in cash to the bank, and 50,000 of that was loan payment. And that's you often hear the term principal, like a principal payment applying to the balance of the loan. That's what I mean by this $50,000. So the loan's going to decrease by $50,000, and then the $5,000 interest is another part of the 55,000. Okay, so how does that transaction impact the balance sheet? So you had $135,000 before. You paid 55,000 in cash to the bank, so now you only have 80,000. The bank loan went from 90,000 to 40,000 because you paid $50,000 of principal. So now you only owe 40,000 to the bank. And the surplus actually went down from 55,000 to 50,000. So that basically means that 5,000 less is owed to the members. The members are eventually going to receive $5,000 less. And the next slide, this is actually from the income statement. We're going to show on the income statement why this number is now 50,000. The $5,000 interest payment is recorded as an expense. And if you remember before, it was 55,000, and now it's 50,000 because of the fact that 5,000 was paid for interest. So a really important point to understand here is, often transactions are going to impact multiple financial statements in a lot of instances, and it's also important to realize that the $50,000 principal payment, it doesn't show up on the income statement at all, because it doesn't have anything to do with customers. It's just internal, how you're funding the business. And the way I would sort of think about that is, on the balance sheet, you have to show that the balance of the loan went down. Okay, this is basically what I just said. It's really important to understand that just because you're paying cash out to another party, that doesn't mean that it's an expense. It does not always mean that it's an expense that's going to show on the income statement. I mean, most of the time it probably will, but it's not the case that it always will. And I have found that this sort of concept is really hard for people to understand, because in their mind, if you're paying out cash, then it's an expense. It has to show up on the income statement. It impacts, how much I'm going to have left over after dealing with the customers. Yeah, and the opposite of that, if you have cash coming in, those are not always sales, which is another it's another, that's another thing that's, naturally hard for people to understand because it's really not intuitive. I mean, if you have cash going in and out, that really seems that you should include that on the income statement. And there's going to be a lot more instances, a lot more transactions that are subject to these sort of, I guess I'll call them principles that we didn't go over. It's not just the ones we went over. Okay, so we have skipped the cash flow statement. Just the cash flow statement is going to be impacted after every single transaction, but just in the in the interest of time purposes, we're just looking at it at the end of the year basically. And this cash flow statement is for the whole year 2022. So it is not as of a specific date, it's for a period of time. In this instance, the whole year. This top number, it's basically showing the 300,000 that came from the customers from bread sales, and then the 200,000 cost of goods and the cash expenses of $50,000. So what's known as the total operating cash flow is 50,000, and in this particular example, the 50,000 happens to agree with the surplus on the income statement, but that's not always going to be the case. But all of these numbers correspond to cash actually going out. It also shows the $20,000 of cash that went out that was paid for the oven. And then it shows the $10,000 that was collected from the members for the memberships. It shows a $90,000 bank loan, and then it shows the $50,000 payment. So if you add up all of those, the net is $80,000. So what that means is the cash balance went up by $80,000. From the beginning of the year to the end of the year, the cash balance went up by $80,000. And since it's a new co-op, the beginning was $80,000. So the ending has to be $80,000. The cash flow in this instance, 80,000 perfectly matches the ending balance of cash, but that's really just a mathematical, I guess, output because of the fact that we started at zero. I mean, very rarely will those numbers match, but they happen to in this example. I mean, you might have 80,000. Well, yeah, never mind. That doesn't make sense. Okay, so comparing and contrasting a Costco membership, Costco calls they call it a membership, and then a co-op membership, and they're two separate concepts, even though they have the same name. So for a Costco membership, you're acting as a customer basically, because you don't share in any profit. I mean, all of the profit is going to the investors. None of it is going to be going to the people that bought the membership. In that context with Costco, that membership that they receive is actually revenue to them. It's going to show up on the income statement. And then the co-op membership, and when you talk about a co-op membership, you're actually acting as an owner, not a customer. So they're fundamentally different. And the co-op membership, if you remember, it was on the balance sheet. It didn't impact the income statement. And why are you acting as an owner, or how do you know? Because you're going to share in the year-end surplus. Now, you can have an instance where a co-op member is purchasing bread. So you can be one of the 5 co-op members, and you can walk in and buy bread. So in that example, you're actually acting as a customer. not really as a member. So that amount you pay for the bread is actually going to show up on the income statement. It's actually revenue to the co-op. The general What I would generally say is, if you have a transaction like that where you're dealing with memberships, the question to ask really is, am I acting as a customer or am I acting as an owner? And that's that in most instances, that's going to tell you how it's going to be recorded. If you recall, there was a $50,000 surplus on the income statement. That 50,000 surplus is not equal to cash in the bank. This is another thing that people actually struggle with, understanding is, just because your income statement shows a certain amount, like $50,000 at the end of the year, that does not mean that you have $50,000 in the bank. They're not really connected. So, just like it's a very important concept to understand. You might get $50,000 surplus, and there's much less than $50,000 in the bank. If we scroll back up, we will see on the balance sheet that there's actually 80,000 in cash, which is obviously different than the $50,000 surplus. So, the main point is this: just because you have a surplus, that does not mean the cash balance should be exactly the same. So at the end of the year, there's a big decision that needs to be made as far as the surplus, and that is, how are you going to split that surplus between the patronage dividend, which is ultimately going to go to the members, and how much is going to go to the unallocated reserve, and that is going to be retained by the co-op. It's never paid out to the members. You could allocate all $50,000 to the members, and then have the co-op retain zero. I mean, a natural question is going to be, why? Well, I don't want the co-op to retain any money. I want all 50,000 to go to the members. I mean, that seems like a very logical question. And as we'll see later, there's a lot of considerations, and there's a lot of reasons why you would give some of the money, some of the surplus, to the co-op. Just speaking as like an accountant, over the long term, it's never going to work to allocate all 50,000 to the members. It's just, like, in a business sense, in a financial sense, economic sense, it's not going to work. It will create big problems. Okay, so the splitting of that 50,000 between the members and the co-op involves really two steps. The first step is to decide how much you're going to allocate to the how much you're going to allocate as a patronage dividend, or how much you're going to pay as a patronage dividend. Sometimes you'll hear the term patronage dividend distributed to the members. It's all talking about the same thing. It's just a different name. And then how much is going to be retained by the co-op. So that's the first question. How are you going to split the surplus between the members and the co-op? The second step you're going to have to consider is how much of the patronage dividend. So how much of this amount is going to be paid in cash? So you often hear the term, how much is the co-op going to pay out as a patronage dividend? In this concept, the terminology is a little bit misleading, because almost always you're going to pay out only a portion of the patronage dividend as cash. And then the amount that's retained is going to be paid out usually, it depends on the bylaws. It's going to be different for every co-op and their needs, but you might allocate $20,000, or you might pay out 20% of the patronage dividend to the members today, and then the other remaining 80% is going to be paid out in the future. So, so in step one, you're determining how much of the patronage dividend is what the patronage dividend is going to be, the amount, and then you need to determine how much of that patronage dividend is paid in cash. And the minimum is $20,000. There's 20% minimum has to be paid in cash. That's a congressional requirement. So there's no getting around that. I mean, you could pay out 100% of it as cash, but as we'll see later, there's reasons why you would not do that. This is just a hypothetical allocation or splitting of the $50,000 surplus. I just chose these numbers at random. There's no reason why 30,000 needs to be paid to a patronage dividend. It could be 50,000. And then the remaining 20% is allocated reserve. That refers to how much is going to go to the member, or that's how much is going to be retained by the co-op. Okay, so that's step one. Step one is this top level, determining how much of the patronage dividend, how much is going to the co-op. The second decision is basically these bullet points. How much of that $30,000 patronage dividend you're going to pay in cash? In this instance, I just said 6,000 is going to be paid. 6,000 out of 30,000 is going to be paid to the members today, and then the 24,000 is going to be, I guess the way to look at it is it's temporarily retained by the co-op that will be paid out in the future. And just something to just mathematically, I guess 20% of $30,000 is 6,000. So, in this instance, I just chose the minimum, $20,000, but it could be more. And here's actually a really good reason why you cannot, why the some of the surplus is going to have to be retained for the co-op and cannot go to the members, because the co-op has cash needs in the future. It has to buy equipment. The oven's going to break down eventually. You have loan payments, so it's basically for the future cash needs of the co-op. Okay, so now we're going to see the financial statement impact of this $50,000 split. Okay, so before there was $50,000 of surplus, and that was split between the allocated reserves, which is it's the patronage dividend. Just on the financial statements, it's usually called something like allocated reserve. It's not called patronage dividend. So 30,000 of the 50 went to the members, and then the remaining 20% went to the co-op. So that's why surplus is 0, because it was split between these two categories. And then 36,000 of the $30,000 patronage dividend was distributed to the members. So we also need to think about that and account for that on the financial statements. So the cash was 80,000 before, and now it's 74,000 because 6,000 was paid out to the members. And since 6,000 out of the 30,000 was paid out, that means there's actually $24,000 remaining to pay out to the co-op members in the future. And just from a bigger picture, when you see this allocated reserves of 24,000, you know that that's how much that the co-op ultimately has to pay out to the members. That is the purpose of this. That's the purpose of this line. It keeps track of how much the co-op is eventually going to pay out to the members. And this $20,000, which is, forever or permanently retained by the co-op, it's not going anywhere. It's never going to be, well, I shouldn't say never, but it's not designed to be paid out to anybody else. So that this number, this line is showing you that the total amount that the co-op is keeping. And it's easy to understand the fact that it's $20,000 because we're only talking about 1 year. But when you talk about like 10 years or 30 years, it's going to go up a lot. Some years maybe it's going to go negative. And then when you're thinking as a co-op how the 50,000 should be allocated to the members and the co-op, there's a lot of different things to consider, and there's a very important point to understand is there's no correct answer. There's no correct answer as far as how you split or allocate that $50,000. But just some high level things to consider is how much cash on the balance sheet the co-op has. And another thing is forecasted business prospects. If you have a bakery opening up across the street from you, well, then you would expect that the business is not going to, make much money in the future years. So that's going to, influence, how much you allocate. You also need money for future loan payments. And then the equipment's going to wear out. So you're going to have to replace that. And there's just many, many more things that consider. It's just a co-op by co-op decision basically. And just remember that $20,000 or 20% of the patronage dividend has to be paid out in cash. Okay, so what we talked about before is really, I guess, financial statement purposes, and then there's tax consequences in how you allocate that $50,000. The amount that's paid out as a dividend is taxed to the members. So the members are going to have to pay tax on this 30,000 of patronage dividend. And they're going to have to pay tax on $30,000, even though they only received $6,000 in cash. The purpose of the minimum 20% is so that the members have enough money to pay tax on all of the $30,000. And I don't know, it depends on, I guess, the members' tax rate, but 20% might be enough. It might not. So if it's not, then that's another decision that the co-op has to consider. Although the more co-op members you have, the harder it is to really consider that factor as far as the tax rates and that sort of thing. Okay, and then the 20,000 that's retained by the co-op, that is the tax on that is paid by the actual co-op. And right now the tax rate for corporations is 21%. So the co-op is going to have to pay $4,200 in tax actually to the government. So that's probably another thing that you would potentially consider as far as allocating it, because how you allocate, if you allocate all 50,000 to the unallocated reserves, or which means to the co-op's going to pay tax on $50,000, and the members they're going to pay zero because the patronage dividend would be zero. I guess the bottom line is if you have a $50,000 surplus, somebody has to pay tax on the $50,000 surplus. It's going to be either the members in their capacity as just individual people, or the co-op. Somebody has to be taxed essentially. Okay, so this looks really complicated because it's got a lot of numbers on here, but it's actually not that complicated. If you remember, in the scenario, we define patronage as hours worked. So that's going to tell you how many hours the members worked is going to determine how much of the 30,000 they're going to get. Because remember, the $30,000 is really it's basically at a co-op level, but that $30,000 is going to be the patronage dividend is going to be split between the individual members. $30,000 is like it's an aggregate number, and it's going to be split between the members. So just this hours work column, there were 1,000 hours worked total by all the members, and then above this shows how many hours they worked during the year. So Fumiko, she worked 150 hours out of the 1,000. So that's 15% of the hours. So that means she's going to get 15% of the patronage dividend. You can see down here, the total is $30,000. This refers to the $30,000 that we've seen on the previous slides. And $6,000 was paid as part of a patronage dividend. And that we saw in the previous slides, her portion of the 6,000 is 900. So the way you get that number is Fumiko worked 15% of the total hours. So she gets 15% of the $6,000. So she's going to get $900 in cash. And we also saw that the 24,000 on the previous slides, which the co-op is going to retain for future payouts to the members. Since she worked 15% of hours, she gets $3,600 of that 24,000. So her total patronage dividend is 4,500, which is 15% of the $30,000. I guess most of the things that we have talked about are really looking at it at the co-op level. What's going to happen to the co-op? It's not really, most of it hasn't really considered the individual member and how these things are going to impact them individually. This is looking at things more from a member's perspective. All the members are going to receive their regular paycheck, just like I assume that they're getting now. And they're also going to get the patronage dividend, which corresponds to their proportionate share of the $30,000. And a portion is going to be cash. So Fumiko, on the right side, this is showing the example from Fumiko's perspective. She gets her regular paycheck during the year, and then her patronage dividend was 15%, which is 15% of the 30,000. She immediately is going to get $900 in cash, and then she's going to, the co-op's retaining $3,600 temporarily for her. It will eventually, in best case scenarios, assuming there's eventually cash, she's going to get this $3,600 in cash eventually. It may be next year, it may be 10 years from now, but she's eventually going to get $3,600 more. And this term credited, that's really just a fancy way of saying that the co-op is keeping track of how much they owe her. So it's just recording. It's usually not going to be recorded on the financial statements of the co-op. It's going to be in some supplementary, say, spreadsheet or some other way. It's just saying that the co-op is, keeping track of how much they owe her. Okay, so, and they're gonna basically credit the member account. Each member is going to have a what's called a member account. It's sometimes referred to as a a capital account, but that's just showing how much the co-op owes to the member. So just really quickly, Fumiko had a $0 beginning member balance because there was no co-op. She paid in $2,000 of her for the membership contribution. She got her portion of the patronage dividend was $4,500, but she received $900 of that in cash. So if you add up all those things, the amount that the co-op owes Fumiko is $5,600. So if she leaves, an ideal situation, she's going to get $5,600. I mean, there's a lot of things that are going to be, have to be considered of whether she actually gets $5,600. But the general concept is that's how much she should get when she leaves the co-op. And then just a quick note: everybody's member balance is going to be different, and because each member worked a different number of hours, so their number could be less than 5,600, or it could be more. Okay, so this is the last slide, I promised. This is just some sort of practical advice: is set up a savings account and make regular transfers to it from, use some sort of formula. So as an example, transfer 5% of your revenue to the savings account. So what it's doing basically is helping ensure that you have sufficient cash to pay taxes for the co-op and, fund future equipment purchases as a sort of reserve in case there's an emergency and you need cash. I see a lot of instances where even where the business was making a lot of money, they don't really plan for the future. They're not really setting money aside. So when it comes to them having to pay tax or whatever, even though their business is making a lot of money, they don't have the cash to pay things. So this is just a way to alleviate that problem. I mean, that is a huge problem in businesses. And then another example is, I didn't know what to call this, so I called it equipment schedule. But make a list of the equipment that needs to be replaced. Like, you're going to have to replace the refrigerator in 2028 and then the oven in 2032. So make sure you have a list that you plan out ahead and think about, like, say, every single year and how much it's going to cost to replace it. That's also going to, help you when you decide how much of the surplus is going to go to the members and how much is going to go to the co-op. It's going to help you assist that. Okay, that is basically my presentation. I don't know if anybody has questions.
Yeah, I have one, and that is, so the allocated, the unallocated reserves, you had a number, but my question is, how fixed is that number, and where in the documents is that then established? So in other words, can you change it?
Yeah, absolutely. That's an excellent question, because that's a really critical question. So it's I guess when you say fixed, do you mean can you change it year to year, or are you saying that, or are you asking once it's established at 30,000 or 30,000 for a particular year, it has to stay there forever? I think I'll provide some general comments, and then, you tell me if it's really answering your question. So the $30,000 is just, that's a number I just made up. It could be, you could do zero, right? There's no law that says, it has to be $30,000. Now, there is a requirement that it has to be a written, there has to be something written before the year starts, determining how you're going to allocate it. Okay, so it's usually in the bylaws. If you could have in the bylaws, you could say, we're going to allocate 50% to the co-op and 50% to the members, and you could use that and say, we're going to follow that, and we're never going to change it. That might not be a good strategy, but how you are going to allocate those numbers is going to be, it's going to be usually in the bylaws. I mean, sometimes it might be in the articles of incorporation or somewhere else, but it's usually written somewhere, and it's written somewhere so people can't just change it all the time, and they can't say, oh, I don't understand why you did that. Now, there is actually, so on the internet, I found some, I guess they're sample bylaws from California, where somebody wrote some, I guess, as an example, they wrote some bylaws that others can use, and they can modify them to their uses. And in that document, in that example bylaws, what they had as a default is 75% is going to go to the members, and 25% is going to go to the co-op. And the bylaws said that, this is what we're generally going to use, but if the board wants to change it, they can amend the bylaws. But I guess the main point is, in the bylaws, it said that, our goal is to do 25% to the co-op and 75%. Now, I guess as a little bit of an aside, I think that's really aggressive. It depends on the co-op. But I mean, in most co-ops, I would expect, if you're allocating 75% to the members, you're chronically going to be short of capital, just in general. I mean, some co-ops that's going to be fine, but I think that's aggressive. Does that kind of answer your question?
Yes, partially, but if you put in a fixed percentage into the bylaws and then you want to change it, now you have to go through a process of changing your bylaws. So is it
Yes.
also possible to have a methodology in the bylaws and say, okay, well, the way we're going to do this is this way, and this is the way we're going to make a decision about how to do it, for any given year?
That's touching on a little bit of, I guess, a little bit of a legal question, but I would think so. I mean, I would think that would be fine. I mean, yeah, because you can't have bylaws that never change. I mean, it might be hard to change the bylaws, and it might be a hassle because you might have to get like consensus agreement or whatever. But I mean, I think that you would have to have the ability to change the bylaws.
Yeah, of course. Okay, thank you.
Yeah.
Okay, are there other questions people have? I see one in the chat from Evan about asking if that $5,600 number was taxed, or would it be just the 3,600 since her cash was
Okay, I don't see can you repeat the question? I guess
Sure.
I can't really.
I think it refers back to the patronage refund. If the $5,600 number.
Yeah, I think it was like slide 29 or something like that. It was
29.
the individuals.
Yeah.
This one? Is it this one?
30, try 30 or 28.
Yeah, okay. I think I'm
It's
probably,
Fumico's, it's when Fumiko gets her,
oh, Fum, okay, I know which,
you know
okay,
which one
so,
I'm talking about? Cause she
well,
gave
I know
2,000. No,
approximately which one you're talking about.
yeah, okay, now we're starting to get there.
Is it this one?
Nope, it's one more down, maybe two more.
Okay, okay, we'll keep going.
That's the one.
Okay, okay,
So,
yeah,
so the reserves that the co-op is holding there for her, keeping track
uh-huh.
on her member balance sheet, member account, says it's 5,600. So she decides to leave. She's going to get a check, maybe, hopefully, for 5,600 bucks. But she gave 2,000 of her own money at the beginning, so therefore her taxable amount would be the 36.
Okay,
The balance.
actually,
Is
so
that
in,
correct?
I think it's partially correct. So in this instance, she's actually, if she gets 5,600, she's actually going to pay zero tax because as far as the 2,000, she's just getting back the
Her money, right?
her money. I mean, since in this instance, I mean, she paid $2,000 in, so she's just getting the $2,000 back. So there's like no, I guess, surplus. Like if she got
And
back
she's giving
three,
that money at zero interest. So even if she's there for 10 years at the 2,000, she's still getting 2,000 back, right?
so if there, yeah, since right, yeah, that should be the case.
Minus inflation. So I mean, her 2,000 she gets back isn't worth what it was when she gave it.
Yeah, well, yeah, yes, that's a totally separate issue though. Like,
Yeah, I know.
you know, that doesn't that's not really going to, unfortunately, yeah, that's not going to
Well,
impact
well,
her
what
tax.
the point that I'm trying to get to is her original contribution isn't anything that she gained through a dividend or a a success. And
Yeah,
I'm
I mean,
I'm a little hazy on this patronage dividend line. That's the cash plus allocated reserves.
okay, yeah, so that might be because you know, I sort of, this is sort of, you know, netting it. Um, so I could have put another line in to make it maybe a little bit more clear. But
Okay.
the 45, let's go back to, okay, so like this one, you can see the total she's getting is 4,500. That's 15% of the 30,000. That's her proportionate
Right.
share,
I follow
right?
that.
Okay, you got that. And then the $900 is the cash she got. So that, so the co-op doesn't owe her 900 since they paid out.
Right.
Okay, so that's where those numbers are coming from. Let's go back. Okay, so I mean, if she, let's see, so she is actually going to pay tax on, she's going to pay tax on the 4,500,
That's yeah.
which includes the, well, okay, let's take a step back. When she during the year when she gets the patronage dividend, when it's allocated to her, she's going to pay tax on 4,500, even though she only got 900 in cash. Okay, okay, but then, you know, as a consequence of that, you know, they still owe her what, $3,600. Since she already paid tax on that, this is sort of a special rule for co-ops. When she gets that $3,600, which is the net of these, you know, these numbers, she's not going to pay any tax because she already paid tax on it. I mean, this is like a special co-op rule, so she
Right.
should not have to pay tax on it. So when she gets to 5,600, she's definitely not going to pay tax on, you know, the 45. She's not going to pay tax on the. She's really going to get 3,600.
And
So she's not going to pay.
this example is specifically for a worker-owned co-op rather than a community-owned co-op that perhaps might be worker managed. Is that correct? Like
Oh, okay. So you're talking about like if the, you know, instead of the members being the, you know, the employees, like if it was like the
right.
customers,
So I'm a
essentially.
member of our local food co-op. They don't ever send me a check for whatever happens. I just
Okay. Well, oh
pay
yeah.
a little less at the register and support good food. And I think I could get
Right.
my $24 back if I said I've had it and I want my $24 back, and they'd have to give it to me. That I paid back, in 84 or whatever.
Yeah, yeah.
So
Well,
my $24 was worth a lot more back then, but they would just give me, if I said I'm done as a member, I would just get the 2,400 or the $24 back.
yeah. Oh, yeah. That's a really good question. Because you touched on, your example. It showed the difference between, maybe a customer and a worker co-op. So
Right.
there's a special rule, that says if it's like a customer co-op, which is, a customer co-op, that if you're, as a member, if you're buying from the co-op for things for your personal life, like living expenses or something you're going to use in a non-business capacity, then it's never taxed. And there's a special rule too, that if the co-op is basically serving people that are mostly buying things for their personal use, which you would expect it like a grocery store, they don't have to send forms to you, that's going to tell you how much you're taxed. So I guess the answer to your question is, in that example, since most of the people are going to be using a co-op in a personal capacity rather than as a business, it's never going to be taxed. Yeah.
From an income point of view, not necessarily a state sales tax point of view, of course.
Yeah, well, that's a different,
I know. I'm just making a distinction that the term tax is so broad that
yeah, maybe I should have said
it's
income
really
tax,
important to be clear that, there are certain taxes that you pay, like, for instance, a business pays B&O tax.
yeah.
It's not based on profit or loss or what you retain, it's your gross sales, which is why it's a regressive tax. But that B&O tax is an expense, as I understand it. It's a state tax, and so it would come off your I want to say balance sheet, but I think I might be putting it in the wrong spot.
Yeah, that would generally come on the income statement.
Income statement, yeah.
Yeah, so the B&O is it's just for businesses, right? So
Right.
yeah, so
But a co-op has to pay B&O tax, right?
oh, I see what you're saying. You're talking about not the member, but the co-op itself.
Right, because
Okay,
the model that we're attempting to put together is a consumer-owned co-op. I should be clear about that.
Okay, yeah, so so that's talking about like state taxes. So yeah, there's not, the fact that you're serving people that are buying things mostly for their personal use rather than the business, that's, you're still gonna have to pay the B&O, but the B&O tax is going to be assessed against the co-op, not the members.
Exactly.
Yeah. So you're exactly right that that's really an expense of the co-op. Well, no, let me think though. I don't know how. Well, if it's assessed against businesses, it can't. Then I would think it can't be charged to the patronage dividend, because that's usually not a business. I'm not sure how I just off the top of my head, I don't know how the B&O is handled with co-ops, but I would think that it's going to be assessed against the
gross sales. It's a
yeah,
gross sales.
yeah. I know it's a gross
Yeah.
sales, but I guess the question is, who is going to have to pay it, and I think it's going to be the co-op.
It's got to be the co-op.
Yeah.
Because the consumers are basically, as you're saying, doing things for their own. In this model that I'm trying to get my head around, like, basically the co-op is a corporation.
Yeah, exactly right.
So it's not quite the right term, but the memberships are basically shares in supporting that co-op, that consumer co-op. And you do know why bakers go to work every day, don't you?
why bakers go to work? I actually know. Tell me,
It's
please.
because they need the dough. I just had to get my baker pun in there. I have a
No,
few
that's
more.
yeah, yeah. I guess going back to the B&O, yeah, that's I mean, any co-op is going to have to pay that.
Right.
So the fact that you have a consumer versus worker, I mean, it's not really, it doesn't matter. Unfortunately,
Well,
unless there's
that goes for unemployment insurance, the food tax 940.
yeah, exactly.
All
Yeah,
those are retained by the business and have nothing to do with the members themselves. Even if it's a worker-owned co-op, the organization itself, the co-op, is responsible for those quote unquote corporate liabilities. And those would
yeah,
end up
yeah,
on
yeah,
your income statement, which is totally separate from this.
yeah. I mean, since it's on your income statement, it's going to reduce the surplus that
Right.
it's. But yeah, no, that's exactly right. I mean, like those things like the 940s and stuff. That's really a tax you're paying because you have employees. Yeah, which would never be assessed against the customers. But yeah, no, you're exactly right. It's going to be.
But even in a worker-owned co-op, right?
You're still going to have to pay it, right?
But the business is paying it because it's technically the employer. Like, it is the employer that all the workers, be they owners or not, work for, right? I mean,
Yes. So, okay. So with corporations, which I mean, just from a tax perspective, corporations are a little bit unique compared to everything else because for tax purposes, the corporation is totally an independent entity or independent body compared to the members.
right.
So yeah, so it has to be paid by the corporation. I mean, since they're the ones that are actually running the business. I mean, since I guess technically, I mean, I understand the employees are running the business, but technically it's the business is the corporation, not the employees. So they have to pay it. I mean, if it's like a partnership or something, it's a little bit different. It's gonna
No, we're
ultimately
talking
go.
co-ops here, and
Yeah. So
so I'm trying to get really clear that there is this, even though everything's all together, there is this separation between
yeah,
what is the business and the individuals that have either bought in with their dues. And if they work there and own it, the corporation still is kind of there. It's the overarching veil. If
yes,
the workers are getting income, they're going to pay tax on that, just like if you get a paycheck. Like
Mhm.
I pay income tax every year, and the business itself accumulates tax liability, but it's separate, even though I own 100% of the shares right now. They're two different things.
Yeah. I think that's exactly right. I mean, maybe the best way to think about it is, is the individual acting as a employee or,
Right.
as an owner of the business. That might be the best way to think about it. Because if you get like your salary or whatever is going to be, you're paying taxes as a individual versus like
Right. Whereas if
yeah.
there is a surplus with the business, and by some grace of the goddess, dividends were paid out to the shareholder, me, then
Yeah.
that would be taxed on me rather than on the business.
Yeah, because they're giving it to you
Exactly. As an
yeah.
individual rather than as an employee where I work and get a regular salary running as a worker.
Yeah, you're exactly right. Yeah.
Okay.
No,
Okay.
I think you have the right idea. Yeah.
I'm still back at the allocated reserve being taxed to a member who doesn't see that money. And
So
so they
Yeah.
end up eating the tax bite at whatever their particular tax category is or tax rate. And maybe they don't see that money for years down the road, and yet they've paid this huge, potentially huge chunk. So I guess my question is, how do you strategically figure that out? So first question is it done by individual, or does everybody in the membership get treated the same? And then again, how do you strategically set this up so that people aren't going, oh my God, I got $900 in cash, but I owe $1,500 in taxes.
So Chris, let me jump in on this, and then if you want to add on, please do. So one of the things that Chris kind of mentioned this about setting up a savings account. I also would recommend that co-ops,
Yeah.
have an operating budget, but you also create a capital budget, and the capital budget will allow you to sort of plan out retiring equity, and that's something a lot of co-ops, especially worker co-ops, don't really get around to. And so to retire equity means you really have to manage your cash flow and really understand the cash flow. And that's why the cash flow, it tends to be ignored of the three documents, yet in a lot of ways, it's probably the most important, because if you're going to pay out that retained equity that's allocated reserves, you need to have cash, but it's also means you need to have cash that's available for transferring items on the balance sheet, right? Because it's a balance sheet experience. And so this really means making sure that your cash flow is such that you can pay out equity without hurting your operations. And that's something that actually is one of the reasons why, the P&W was known for lumber co-ops back in the 50s, and they mainly went out of business because they didn't have the cash flow to pay out their members' equity. And the only way that members could get their equity out was to sell the co-op, right? And so that is something that happens to a lot of co-ops. Like my co-op Union Cab never really managed to figure out how to pay out its equity. In terms of some of the questions you asked, usually speaking, the members have to be treated equally when you pay out equity. Traditionally, you pay out equity in the year in the order in which it was earned. So, for instance, equity earned in 2020 is going to get paid out before equity earned in 2021. There's another way of doing it where you pay out a percentage every year. Like you might say, we're going to have a 10-year rollover, and every year we're going to retire 10% of our equity, and then everybody gets a check regardless of what year it was earned. They get a 10% of their equity back every year. So there are different ways of doing it. It requires some planning. It requires some thought. Usually this is a board of directors decision. You don't necessarily write these into the bylaws, but I would highly recommend that from the get-go, the worker co-ops in your first year, before you get to your, dealing with your fiscal year numbers, that you create some sort of policy about how long you're going to retain equity and how you're going to manage having that equity roll over from year to year. So you don't end up with someone paying taxes in 2020 and then not seeing the money for 20 years, or longer, where not only is it losing value from interest, but they've also, paid, then their tax burden really, when you account for inflation, becomes even much greater. So, and as someone who has a couple $1,000 sitting in Union Cab from 1993, I can tell you I think it's a way of living up to your values as a co-op, is to really manage member equity this way. I don't know if there's anything you want to add, Chris, but.
Yeah, what you said makes perfect sense to me. I mean, as far as Margaret, your question about, you're getting like $4,500 you have to pay tax on, and you only get like 20% of that in cash. So the specific reason why there's that 20% that has to be paid in cash is to make sure that the co-op or the individual has money to pay the taxes. So so I mean, you're getting 20% in cash. That amount is supposed to be used to pay taxes. I mean, that's the idea.
Yeah, and I would imagine most of the worker co-ops I work with, people are probably in the 15% range for There might be a few where they're up a little bit higher, but, so 20% seems like the right number. I know you didn't cover this in your presentation, Chris, but I was wondering if you could talk a little bit about some of the ways that I know that I've used these documents and something we do when we're vetting co-ops. We'll be talking about this is looking at ratios like debt equity ratio or the current ratio, and just like some of the tools and ways we can use these documents rather than just staring at the paper. But if you want to talk a little bit about the value of like the current and debt equity ratio, what they are, why you would want to look at those ratios.
Yeah, I can say a little bit. I mean, I don't have, I don't have memorized how you calculate some of the formulas. But I would say, yeah, also those formulas are going to be used by the bank probably to assess whether you're too risky to loan to. So they're going to calculate those ratios. I mean, over time, hopefully the ratios improve, but that might not be the case. I guess I'm a little bit skeptical of the ratios for small organizations.
Okay.
Because, and the reason why is simply because, they're small and a lot of times their numbers like jump so much. They jump all the time. So, well, in some instances you can mathematically calculate the ratio. Whether it's increasing or decreasing. I mean, it can change a lot depending on whether you have a profit, and because if you have like 5 members, I mean, if one member is sick, like that's really gonna hurt your ratios, but it doesn't necessarily mean that your business is really over the long term is gonna be struggling. I mean, I guess an example I would use is in the instance of like earnings is I can calculate how much Google's earnings are going to be next year pretty accurately, actually, compared to a small co-op or a small business, because their numbers jump all over the place. Because like if you have what I've seen in some instances is you have a small business that they get money based on contracts. They sign big contracts. So depending on when the contract is ending or when they get new contracts, I mean, it can change their numbers huge. I mean, it's very, very hard to predict how much money they're going to make next year. Whereas Google is pretty, it's pretty consistent. You can just say it's going to increase by 20% because the base is so much smaller. So, I mean, in general, I think that they do, the ratios and stuff, they do provide value. But I think it's not as much value as some people maybe believe. But you also have to deal with them because the bank's gonna, is gonna. I mean, just for myself, I can look at the financial statements even without calculating ratios, and I can pretty much tell you whether the business is a good one or a poor one. But I mean, most non-accountants probably won't be able to do that. So I don't know if that helped.
Oh no, I actually I thought that was a really insightful answer. I hadn't really thought of it that way before. So my other question is sometimes co-ops want to have a non-refundable membership fee. So rather than so somebody pays $50 to join a co-op and they're never going to get that money back. Is that still equity then, or does it become income?
Oh, that's a good question. I guess my initial thought is it should still be equity. But I might be wrong.
Okay.
Because, well, I mean, I guess it would. I mean, I guess you would have to look at the membership agreement, like, and what the rights are in the membership. I mean, if it's just I mean, if it's whether it's tends to be more and an equity or more income. I mean,
Would it maybe be unallocated equity then if it stays as equity, or?
yeah, I think it would be, it would be unallocated because it's definitely not going to the member.
Okay, so it wouldn't become like a Costco membership in that sense?
No, I don't think so. I mean, I guess maybe I could be wrong, but I'm pretty sure that's the right answer.
Okay, no,
As a general statement, without
right.
being a specific agreement.
Then in the chat, Diane asks if what you would think some good co-op business financial indicators would be that you would think people should look at.
Oh, I think that I think that all the financial statements are important because to look at all of them because they all are interrelated. It might not seem that way from the examples, but they actually are all related. But I think cash flow is really important. Like the spreadsheets that you were going to go over, I think the cash flow is really important. I mean, especially in the early years that they have enough cash to survive. So I guess if I would have to pick one, I would say the cash flow statement.
Okay.
But I mean, they're all important. I guess one thing that I would say, I think, which probably is maybe a better answer to is I would pay attention to the debt, like the debt equity ratio. I think, I mean, the more debt, obviously, the riskier it is for the co-op. And hopefully the debt would go down over time.
Okay, wonderful.
Yeah.
Are there other questions from anyone else? Okay, well, I want to thank you, Chris, for your presentation. I'm going to just share my screen for a second. I want to share one of the tools we use, and but yeah, if people can give Chris a kind of applause, I really appreciate you coming in and doing this for us. And I am going to share my screen. So one of the tools that we use is oh, my screen's frozen, shoot, is a spreadsheet that was put out by SCORE, which is a group of retired executives that's operated through the Small Business Administration. And they created this pretty neat spreadsheet to help do a cost projection and cost now. Okay, well, I'm not sure what I'm going to be able to do, if I'm going to be able to show this or not. Can people see my screen or hear me?
Cannot see your screen, but we can hear you.
Okay, so anyways, it will be something, it's in the folder. It's called as for financial projections Excel spreadsheet. And it will, one of the things I think it would be you play with different scenarios and let's see, I think maybe I have my computer. People can see my screen now, I think, maybe.
Yes.
Okay, so yeah, so this is the spreadsheet, and what it does is allows you to, one, you can build out the cost of what it's going to take to do the conversion in terms of the money. So you can list out the different assets, fixed assets, also figure out what your operating capital needs are going to be. and then figure out where the money's going to come from. And so this is the first page. And then as we go through this, let's see if I can, I'm having problems with, so as you can see, there is, let me just, I cannot, oh, I'm having such problems with my computer right now. I'm going to blame this on Putin. He must be doing something. So let's see if I can, yeah, so you can also do payroll. So here you can figure out your payroll model, go through and play around with wages and hours per week. You can also build in the different payroll taxes, and this will flesh it all out. It has a, in sales, Chris mentioned cost of goods sold, so you can actually has a calculator to figure out the cost of goods sold if you don't know it. And it has up to 6 different, sales points, and then also, you can list out your expenses. What I tend to do, you can add more lines, but I wouldn't recommend it. It gets really wonky if you do, but you can try to work your expenses into these categories and then fill them out, and then it'll automatically calculate these. So anything that is in this orange color is where you can enter data, and then it'll change color once you enter the data. We're going to go through this when we meet in this next week with individual people, but also here, you can. But ultimately, when all this is done, it calculates your cash flow for you automatically. It'll calculate your income statement, and it'll do a 3-year analysis, so you can add for different years, and then it'll also produce your balance sheet. And some of the other things that also give you a break-even analysis. So this will allow you to see what your sales need to be able to break even, right? To pay all your bills and including payroll. And so that'll give you a nice goal. And then there are a few other things too. For instance, you can look at your industry that you're in. So if you're a bakery like Blue Heron, you can actually go and see what the normal, what the average numbers are for the different ratios. So you can get your current ratio, you can compare it to the industry you're in, you can look at some of the other models too. Not all of these are going to be relevant for co-ops, but they are still generally valuable to look at, just to get a sense of the overall health of your organization. And yeah, so it's kind of a really quick run through of this, but I wanted to make sure people had it. Like I said, we're going to go through it and work with you on this. This is one of the ways we can kind of see what it costs to replace the owner, even if the owner is staying on and will be joining the co-op, which I think most of you are. It's important because you want to be able to see what that looks like financially. If the current owner, if you're working more than 40 hours a week, that means you're going to have to work in overtime, or maybe you might have to have another person come on to do some of that work. So we need to be able to build that financial model for the co-op, and then this will allow you to get an idea of what you're going to need for working capital to make the transition. And also, what your cash flow is going to look like, and be able to sort of set some of those goals and plans as well. So I don't know if there are any other questions or thoughts for Chris or myself. Such a quiet group right now. Okay, well, again, I guess I want to thank Chris again, and I think we're kind of wrapping up. So please connect with Diane, Luis, or Fred this week, and I will be reaching out for Blue Heron. I know we have some scheduling issues, but next week we will have Luis here to talk about specific, get deeper into equity, member equity, and also Mark from Shared Capital to talk about what you need to do to be loan ready and start thinking about that process. Also, the timeline for doing loans. And I hope everyone has a very peaceful day and enjoy. Hopefully, if we have some sun, maybe today too. I saw a little bit. Great. Thank you all. Thank you, Chris.